Welcome to our series of business trainings that are designed specifically for DBE construction companies in the state of South Dakota. My name is Greg Hansen, and joining me later on will be Chris Hasler. Our company is Project Solutions. We are the DBE support services consultants for the South Dakota Department of Transportation, have been since about 2000. So today we're going to be talking about a topic that comes up often for construction companies. We're getting started. Somewhere where it's new, otherwise it's a topic that needs to be visited. Our learning objectives here are discuss the difference between bonding and insurance. And why do contractors need bonding? Does the business down the street need bonding? Probably not. We also need to talk about the different kinds of bonds that contractors will come across. Then Chris will get into bonding sources for DBE firms, some of the eligibility requirements. Let's start talking about the difference between bonding and insurance. Insurance is something we're all very familiar with, right? We insure our homes, our cars, sometimes our life. We have health insurance. And it's typically a two-party relationship. When you have a claim, the insurance company pays the claim and accepts the loss. That's part of their business model. And if they pay a claim when something unforeseen does happen, so either it's accidental or sudden, so that's insurance. And let's talk about like a car, for example. If you get in a car wreck and you have $100,000 and you have a $500 deductible, you wreck the car, the insurance company will pay out the $40,000 regardless of fault. The insured, you, the owner, pays a $500 deductible, and the insured does not have to pay back the insurance carrier for the additional $39,500. That's how insurance works. But in bonding, it's a three-party relationship. There's the surety, which is also known as the insurance company or the bonding company, is in the middle of this. The surety will pay the claim, but does not accept the loss. They have the principal's indemnity, meaning they expect a repayment of the loss. So this is a different relationship. They are paying a claim when something doesn't happen. When the building doesn't get built, or the road doesn't get completed, or the bills don't get paid, they pay a claim when something doesn't happen. And they have recourse against the project principal who didn't perform on the contract. Well, let's look at another example. They write a performance and payment bond for $1.2 million for Jones Construction Company. Jones defaults on the surety has to hire another contractor to finish the project. You know, the customer pays for the project, but the surety company is still out about an additional $200,000. The construction company is going to go back to the Jones Construction Company as well as the owners to collect the $200,000 loss. So this is the Jones or the people who buy the bonds know this is how it works, so that they understand that if they fail to perform and there is a claim filed, their bonding company is going to come back against them to recoup those losses. Why are bonds required? Well, the lowest bidder gets the project, and here this is a scary way to hold up a bridge, right? So make sure that the contractor has the means and resources to successfully complete the project. It's required by all government projects. The Hurd Act of 1894 and the Miller Act of 1935, and they require performance and payment bonds for projects over $150,000. Now, as you get more into your construction business and learn more about bonding, sometimes the prime contractor will bond the whole project, and you might not have to, or you'd have to pay your portion of it. But it's a good understanding to have this knowledge right here. How about 3 C's of surety bonding and underwriting? We've all probably applied for a business loan at some point. Maybe, hopefully, you've been working on your lines of credit or equipment loans. They always look at the character, the contractor's honesty and professionalism. They look at your personal credit score. That could weigh into their decision. Next one is capacity. the financial strength, working capital, net worth, et cetera. So, if you're going to get a bond for a $200,000 job, that's probably not too hard to do, but a $2 million job, if the biggest job you've ever had is 200,000, might be a stretch because it might not have the capacity to handle the startup costs, the financing needed in the working. Don't have the net worth yet, so capacity. Another one is capabilities. So does your company have the capabilities, the technical capabilities to perform the work? Have you done a project similar scope and size previously? So 3 C's of surety on character, capacity, and capabilities will be all weighed in the decision of the bonding company to approve your application. Of course, there are several different types of bonds, depending on. It provides financial assurance that the bid was submitted in good faith. And then, the bottom bullet here, that the performance and payment bonds will be issued. So when you talk to your bonding company to get a bid bond, and you're hoping you win the project, but they have already decided that they would be able to issue the performance and payment bonds as well. So even though there's work to be done yet that you may or may not win, they're at this point telling the customers that you would qualify for that if you were to win. Here's the example on the bid bond is, this example is $12,500. But the surety will underwrite on the basis of the overall contract, not just the bid bond, okay? So even though you maybe ask your bonding company for just a bid bond, they're looking at the whole project, not just the bid bond. A performance bond, this protects the taxpayers or the customers from contractors not completing the project. So if the projects aren't completed on time, or they're not completed the specifications, and if work has to be redone, the bonding company could be called in to pay for those upgrades or those repairs, and go back to the original contractor to collect the damage. Payment bonds. This is guarantees that payments to laborers, material suppliers, and subcontractors will be paid. Because no one can put a lien on a government project. Mechanics lien sometimes we put on a house or a private project, but you can't plead on a government project. Consequently, that's why bonds are typically required. Guarantees that these people will be paid for the work they've done on a project, even if the general contractor does not. This is a payment to guaranteeing that the suppliers will be paid for goods they delivered to a project. On the next slide, we're going to talk about the different kinds of bonds and how that are by size. Contract bonds up to $400,000 are fairly easy to get, and they use a clearinghouse that they can look at your credit score. They don't require financial statements necessarily, just some information about completed projects, maybe job reference, supplier reference. They have a line of credit at the bank, stuff like that. Personal credit is not relevant, but just it's small and simple, so might be an option for some of you. But if it's over 400,000, which today most projects are over that, they will require, they'll have questionnaires, they'll want bank references, resumes, maybe your tax returns, financial statements, and the forms they want completed. So depending on the size of the bond, be prepared for that. Make sure you have good books well in advance before you make your appointment. Again, you're going to want to be prepared as you start working on bonding. Some of them are going to have more details. They're going to want your job costs, your bid specs. They also maybe want a verification of the investments or statements you've given them. They might want to see that detail, your tax returns, engineering estimates, agent receivables and payables. So just, again, having your background work done in advance is going to expedite the process, and you'll seem much more organized going in if you have this information. I want to put this in there, just like lenders, there are some that are standard and some that are not so standard. Standard surety companies rely on and make bonding for firms with what they would call, we would call excellent credit scores. They're strong working capital, equity, net income, and experience track record. Now, there's still a market for bonding for companies that don't fit that model necessarily. As you can imagine, their fees are much higher, often more than double. So, depending on your situation, you might have to look a little deeper to find a match that fits your need. Well, now that we covered that information, let's talk about sometimes there's going to become conditions of the bond. For example, they may require collateral from your personal resources or the business resources, 10% to 30%. Sometimes a letter of credit from your bank will qualify. Put a cash. Some people will have a savings account that they can put up as collateral. So something to think about. They will oftentimes want collateral, especially when you're getting started. They also may, when you do have a bond as part of the contract, they may require you to escrow the contract funds. That third party will administer the handling of the funds, so they want to make sure the contractor is getting paid, and the subs, suppliers, labor, etc. The overhead that your company has can be funded as it's available, but just sometimes they want to make sure that the bills are being paid appropriately, that they will escrow payments from the customer on a project. So they may deposit some upfront money or hold back some for any rework that has to be done. So just something to think about or be aware of, that if you get a bond, it could be required to escrow the funds, and it won't go necessarily directly to you, and they take care of making sure all the other bills get paid. Now, with that, I'm going to call in my colleague, Chris Hasler, who's going to talk about some bonding assistance for DBEs and small business, and we'll turn it over to Chris.
We'll begin by looking at some of the program details and qualifications for the U.S. Small Business Administration Surety Bond Guarantee Program. The overall purpose of this program is to increase small businesses' access to government or private sector contracting by guaranteeing bid, performance, and/or payment bonds for qualifying small businesses. The program will guarantee individual contracts of up to $6.5 million or up to $10 million if they are federal contracts. In this SBA program, there are a couple of different options for firms looking to obtain a bond. This first one on the slide, which is sometimes referred to as the full program, will guarantee a contract of up to $6.5 million. The firm must possess 5% working capital for the amount of the bond that they're attempting to obtain. But for SBA purposes, a bank line of credit will qualify as working capital. So in a quick example here, if a firm is seeking to obtain a bond for $1.5 million or a bond capacity of $1.5 million, they must have $75,000 in working capital. In this example, $25,000 is firm assets with a $50,000 bank line of credit would reach the 5% necessary for the $1.5 million bond capacity. Another option is sometimes referred to as the QUIC program or the QUIC application program. This is a program for projects of up to $400,000 There is a short form application with no firm financials required as part of the application. This program is for firms with low credit scores or maybe unestablished credit. The bonds will be for 2 times the largest completed project that the firm has worked on. There are a number of qualifications necessary for participation in this SBA program. First, the contractor must need a bond as a prerequisite for bidding on or performing the contract work. To say it another way, the contract must require a bond. The contractor must also be unable to obtain a bond without the assistance of the SBA. The contractor must be fully responsible for the oversight and management of all subcontractors, and the contractor who is obtaining the bond needs to perform at least 15% of the project themselves. All firm owners with at least a 20% ownership interest in the contracting company must prove that they're not currently debarred or suspended or otherwise ineligible to participate in these sorts of transactions with any federal department or agency. The firm must meet the Small Business Administration business size requirements for the primary NAICS code in which the firm works. The Small Business Administration will also examine factors such as the contractor's criminal history or history of bond claims. And there are some additional qualifications that are just too numerous to list in this brief presentation, but some include the firm must have no open tax liens, no open bankruptcies. The contract in question must not have a liquidated damages clause exceeding $5,000 per day, and the contract must have no maintenance clauses greater than 2 years. I have placed a couple links in this slide. At the first link, there is an excellent breakdown of the requirements for this SBA program. But the best source of information is the Small Business Administration itself. And in the second link on this slide, I have placed the current contact information for the SBA Surety Bond Guarantee Program. The second program that I'd like to touch on in this presentation is the U.S. Department of Transportation's Bonding Education Program. The U.S. DOT Bonding Education Program is designed to assist small businesses, particularly in the transportation or construction industries, with general business growth as well as increasing their ability to obtain bonding. The program contains 2 major components, one of which is an educational workshops component, and the other is a bond readiness component. These 2 components run concurrently, meaning, as you'll see in upcoming slides, as your firm works through the educational workshops, you'll also be using those meetings and workshops to interact and complete the requirements for the bond readiness component. The educational workshop component is set up as a series of educational courses and has historically consisted of up to 10 courses. An introductory workshop on intake and logistics, 8 comprehensive workshops in various topics ranging from construction accounting to estimating to project management, and then finally a closing workshop focused on networking and then next steps. These workshops are designed to provide information to the contractors related to improving their company's operations and thereby making it easier to be bonded or to increase their bonding capacity. The second component, the bond readiness component, consists of one-on-one meetings between the firm and surety bond producers, underwriters, and other bonding professionals who will work with the contractor on a case-by-case basis. Again, this component runs concurrently with the educational workshop component, and so these one-on-one meetings would be taking place generally before, during, or after the educational workshops. Together, you'll assemble the materials necessary for a complete bond application, conduct bond readiness assessments, and develop tailored measures to address any deficiencies that might deter the successful underwriting of a bond for your firm. The qualifications for this program are a little less strenuous than the qualifications for the SBA program. Your firm must have existed in business for at least 2 consecutive years with annual revenues of at least $250,000. Your firm must have a minimum of 2 full-time employees, which can include the firm's owner. Your firm must be actively pursuing transportation-related contracts and have a history of past performance in the construction industry. Your firm must be interested in satisfying the credit, capacity, and character evaluations during your consultations with surety representatives. Your firm must have one of the following certifications or designations: Disadvantaged Business Enterprise, Hub Zone, Service Disabled Veteran-Owned Business or Veteran-Owned Small Business, Woman-Owned Small Business, Small Disadvantaged Business, or Small Business Administration 8A certification. Finally, just a quick note, consultant firms, developers, and engineering firms are not eligible for this program. To learn more about the US DOT Bonding Education Program, the US DOT website contains an overview of the program and contact information for the program administrators, and I've placed that link first on this slide. A more detailed description of what the program and the courses have looked like in prior years can be found at this second link.
Thank you for that information, Chris, and thank you to each of you for tuning in and taking part in our training series. We are here to answer any of your questions you have about your business. You want to grow it or bidding questions you have. It's part of our contract. It's all confidential, and services are paid for by the DOT. There's no cost to a certified firm. So here's our phone number and our list of contacts on our team members: Elizabeth, Carrie, myself, and Chris. So again, thank you for tuning in. Your feedback is welcome, and hope we'll see you on another presentation.